Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. You're looking at losses across the board. Some worry there reflected in the market over the lack of progress on debt ceiling negotiations. You're looking at the Dow now off 191 points, Nasdaq off just about 1%, as well as the S&P in terms of the biggest laggards in today's market action. You're looking at industrials and financials really leading to the downside. In terms of the bond market action, not too much movement here in yields, a bit under pressure when you take a look at the 10-year. But again, the big focus on the debt ceiling debate, and that obviously weighing down the broader market today.
Yeah, no question about that, Shauna. But we do have some breaking news coming out of Netflix. The password crackdown has officially come to the U.S. Let's bring in Ali Canal, who's been tracking every step of the way for these details. Ali, what does that pricing structure look like for this?
So basically, we knew this was coming. This is something they said in their earnings call, that at some point in Q2, hide your kids, hide your wife, but your password sharing crackdown is coming for you. And it's not just the U.S. They also confirmed that they are rolling it out more broadly across the world in countries like the U.K., France, Germany, Mexico, Brazil, among others. Now, the company did say a Netflix account is one that is used by a singular household. So if you have a roommate, that counts. You guys can share a Netflix account. But if you have a child that's away at school, that does not fall under their requirements. They said everyone living in that household can use Netflix wherever they are, at home, on the go, on a holiday, and take advantage of some of these new features. Now, these new features are ones that make it easier, or at least attempt to make it easier to share those accounts and to create new ones. Number one, you can manage your device by one single click. It allows you to sign in and sign out of devices. So if you go to a hotel room and you log into Netflix there and you forget to log off of that account once you leave the hotel, you can easily do that in a single click. So that's something they said was a widely sought after feature. You can also transfer a profile. So if you're a person that currently shares an account with someone and you want to go and purchase your own account, but you don't want to lose all that data and all the shows that you've watched in the past, you can easily transfer that account. And then if you want to add an extra member, you can do so for the price of $8 a month. Now, from what I'm seeing, I think you can only add one extra member, which is going to be a problem in my household because I'm one of 3 kids. Who's going to be the one extra member? I don't know. But yeah, this is going to be very interesting. Already we're seeing an interesting reaction in the share price. It initially went up, then it went down. I think investors are trying to understand if there's going to be some churn here. Analysts we know are bullish on it, but still, it's a TBD.
Yeah, Ali, and that's exactly the point I wanted to bring up, because I think there's two different sides of the story when you take a look at this announcement. One side of it is saying that people are going to leave Netflix. They're not going to be willing to pay for their own accounts. On the other side, though, a number of Wall Street analysts have come out over the last couple of months in anticipation of this, saying that this is actually going to boost the revenue here for Netflix. And many of these people who have been relying on somebody else to pay for their Netflix, they're actually going to then subscribe to the ad tier version, which could then help the growth there.
Right. It's a ripple effect. And it's all of these revenue initiatives, not just the password sharing crackdown, but the ad supported tier as well, that hopefully will help lift profitability. If they're growing, they said they would be willing to spend more on content. We know that that content spend is flat year over year. They're planning to spend $17 billion. They're the one player in the streaming wars that have been very aggressive in their content spend, but we're seeing a little bit of a pullback. If these revenue initiatives are successful, though, that could change a lot of the story here. But again, you have to hope that you don't see a lot of sustained churn. Netflix has said that they do expect people to drop out of the service, but that they are going to see that rebound after a couple months or a couple weeks. So that's something to watch in terms of that churn level.
Okay, Ali Canal with that breaking news out of Netflix. Thanks so much for that.
Another tech story in focus today, Apple's multi-billion-dollar deal with Broadcom. Now the partnership will focus on developing 5G radio frequency components in the U.S. Apple saying that this is part of its plan to invest more than $400 billion in the U.S. economy, and the latest move to shift production away from China. Joining us now, I want to bring in Bob O'Donnell, Technalysis Research President and Chief Analyst here. Bob, it's great to see you. So talk to us just about the significance, how big of a moment this is for Apple, given the fact that it's pivoting once again further away from Asia and investing in manufacturing here in the U.S.
Well, obviously, the move to manufacture more in the U.S. is a good thing. Let's remember some of these components have been manufactured in the U.S. Apple has been working with Broadcom, and some of their manufacturing, of course, is here in the U.S. Nevertheless, it's still an important move. You know, we want to see more semiconductor work done here in the U.S., and this is just another part of that puzzle. RF components are really hard to build. They're these analog things that help make 5G signals work. And there's not that many companies who are able to do that. So this is obviously, it's a great win for Broadcom here in the near term, and it's a feel-good kind of statement for Apple. I will say, longer term, there are some questions, though, because Apple is, of course, rumored to be building or trying to build a lot of these components. Of course, they're working on their own 5G modems. Right now, they're using Qualcomm, but the plan is to do their own. These RF components go alongside those modems. They're also at some point planning to do those. So, we'll see what happens. But what it says is, look, Apple needs help with some of these things. They're working with this U.S. company. They're going to probably bring 5G to more of their devices. Right now, it's really just the iPhone. We'll start to see it in the iPad, maybe in the headset at some point, if and when that does come out. Eventually, we'll have 5G Apple Watch. So, and then I think we'll see 5G in the Mac at some point as well. So, all of it is, I think, is generally positive moving forward.
Bob, you read my mind on that because, Apple's made quite a few pivots when it comes to chips, moving away from Intel, then making that announcement about building internally. And then now we've got what's happening with Broadcom. What does this mean for what they're trying to do internally and build more of their stack?
Yeah, I mean, really, you're seeing Apple move to trying to be almost a completely vertically integrated company, which, the old school IBM and you think about the really older tech companies, that's what they used to do. And then everything all of a sudden went horizontal. And now, interestingly, Apple is trying to go sort of more vertical because they want to control their own destiny on this front. And they are big enough, and one of the only companies big enough to support this because they make so many devices, they can use these components in a lot of different places. So I think you're going to continue to see Apple do this, but these things don't happen overnight, right? This kind of technology in particular is very hard to do the RF sort of signaling. And so it's going to take them a while to get that expertise. They're already having a hard time, with the modem. Initially there was a thought that they would have their 5G modem ready this year. Clearly, they're not going to. So, these things take a while, but it does reflect that long-term Apple perspective of wanting to control their own destiny.
Bob, you talked about the broader move that we've seen, tech companies trying to reduce well, not just tech companies, multinational companies trying to reduce their reliance on China. You could argue among the tech names, Apple is among the most vulnerable and reliant on China from a parts and components perspective, as well as manufacturing. Even with today's announcement, can Apple really reduce their reliance on China to the point where they won't necessarily be disrupted, whether it's an economic disruption or, God forbid, something that's more militarily related?
Yeah, no, Kiko, it's a good point. I mean, look, the reality is Apple has seen the issues. They're working to try and diversify manufacturing in particular. The final production of phones and all kinds of devices is still very, very reliant on China. And while they're making moves, again, they are so big, they can't do it all at once, and it's going to take a long time. So yeah, if God forbid there was a military sort of issue that required them to shut things down, that would be really bad for Apple, clearly. I mean, it would be bad for the tech industry in general, let's be clear, but Apple in particular is there. The one thing is, it does seem Apple has a special place in China. They seem to be sort of, they get extra special treatment. And I think they know they're handling China with kid gloves in terms of how they interact and work with the Chinese government in order to make certain things happen. And the truth is, there's a lot of very loyal Apple users in China. So frankly, the Chinese government has this challenge of, you cut off Apple stuff in China, you're going to get a lot of people very upset. So it's a careful walk that they have to take. But yes, clearly, I think you're going to see them try to diversify more geographically on individual components as well as manufacturing.
And Bob, when it comes to diversifying geographically, there's been lots of talk and lots of emphasis here on India, whether or not India can become the new China for Apple. What do you think?
Well, I mean, look, again, I think you are going to see them invest in India, but you're also going to see a lot more in Southeast Asia, right? There's a lot of manufacturing going to Vietnam, some companies going to Malaysia. There's a lot of movement in that direction. And so I think you're going to see India get propped up, and there will be a lot of focus there. But again, it's a couple percentage of the market. And the difference with India versus China, for example, is that there are not as many Apple users in India. It's a much smaller percentage in terms of the share. So not that necessarily matters where they do the manufacturing, but it has some degree of influence, I think.
Yeah, the argument for years has been the higher price point, right, that Apple competes on, and whether that matches where the Indian market is. You talked about reducing the reliance on China, but when you think about where things are right now, I wonder if you can talk about how we have seen the reshaping of the landscape when it comes to chip makers, and how much of that has been spurred on by the CHIPS Act that was passed last year, because it feels like there have been so many announcements of investments coming into the U.S.
Well, there definitely have, Akiko, and I do think some of it is CHIPS Act related. But I think there's also just this recognition that, people in the tech industry have known for a long time, but sort of the general world really discovered during the pandemic of, the devices we couldn't get, and we couldn't get them because of chips. You couldn't get a car because of some of these chips. And it turns out they were being manufactured almost entirely in China, or in Taiwan, actually, where a lot of it is being done. And so I think there is this sense of, we really do need to do it. But again, unfortunately, Intel's building all these fabs. It's 3-4 years before you start to see any production out of them. You've got other companies. Global Foundries is another U.S. chip company that's been built. They've been building here in the U.S. for a long time. A couple other factories around the world as well. You're going to see a lot more of these commitments. You've got TSMC saying they're going to build more in Arizona, Samsung in Texas. So there's definitely motion, but unfortunately, these things, the market likes to see things happen fast. These are not fast-moving changes. So it's going to take a while. I think it's absolutely essential that it happen. And the CHIPS Act became sort of the rallying flag for all this stuff. So I think that's how we're going to continue to see it over the next couple of years.
All right. We, of course, will continue following this story. Bob O'Donnell, thanks so much.
We are also watching retail today. Two big names reporting earlier, Lowe's and BJs Wholesale, and issuing separate warnings on the consumer. Lowe's shares posting gains as results beat expectations, but the company did lower its full-year guidance. CEO Marvin Ellison saying he expects shoppers to pull back on discretionary spending in the near term. Meantime, BJs Wholesale under pressure. Results missed estimates and guided that current quarter same-store sales are tracking below the first quarter. Let's start with Lowe's, Shauna, because in many ways we heard what we heard from their competitor Home Depot last week. We talk about lumber deflation, unfavorable weather, a big part of some of the pullback they saw. And I thought it was interesting, even though they're talking about a pullback in discretionary spending, you could argue Lowe's in more of a favorable position, considering where they said 2/3 of their sales is non-discretionary, and they are seeing some strength on the pro side of things as well as online.
Yeah, certainly. And it's also interesting when you take a look at the reaction that we're seeing in the stock today, because taking into account the guidance that we got from Lowe's, that was not too impressive. Yet we're seeing the move here higher of just about 2%. I think that's largely based on the fact that it wasn't as bad as investors had feared following the results that we got from their competitor Home Depot yesterday, last week. But what we're really pointing to here is just this ongoing trend, the theme that it seems to be from retail earnings so far this season. That is the fact that company after company is calling out the conscious consumer, those that are targeting cost-saving measures, larger box retailers. Those have been the outperformers, those that are more reliant on those staples purchases like Walmart. Walmart was the outperformer when you compare it to the results that we're getting here from Target in terms of how the company is positioned over the next several months in terms of the eyes of many of the analysts that are tracking these results. And Jefferies was out with the notes today on the heels of the BJ's report saying that the company is well positioned to gain market share given the fact that consumers are hunting for bargains. They're going to the places that they know have deals. Walmart, one of those places. That's why a number of analysts saying that they are also well positioned for this downturn if we do see it.
Yeah, I mean, we have heard over and over in these earnings calls about value being the key for these consumers. And you could argue BJ's Wholesale kind of in that position when you think about where things have been on the membership side of things. Remember, they announced earlier that 90% membership renewal rate. So that tells you where customers are looking right now. You could argue Costco, which we're going to hear from later on this week, another one of those names where they are seeing the value customer come back. I thought it was interesting, though, Shauna, we've been talking so much about trade downs, and that being another sign of the conscious consumer, the cautious consumer. We did hear from BJ saying their own brand sales growth in grocery divisions more than doubled that of the overall market during the quarter. So that, to me, sort of also points to where consumers are looking. Yes, they're shopping, but they're also shopping for more value.
They're shopping for more value, and a lot of those higher income shoppers are now making that decision. We heard Walmart talk about that on the earnings call, the fact that their customer base has been growing for quite some time, given the current environment that we're in right now. Now what they need to do is keep that new customer base. So we'll see whether or not they're able to do it. But certainly people are being driven when it comes to their purchases by the prices, and many of them favoring the staples over discretionary items, which did so well during the pandemic.
Yeah, we've heard that over and over. Let's turn our attention now to a number of big tech and mega cap stocks that have been soaring this year. We've got Yahoo Finance Jared Blickery to break down the charts for us. Jared.
That's right. And let's take a look at some of what's happened this year, especially in the mega caps. This is the Nasdaq 100, and you can see Apple up over 30%. So is Microsoft, Alphabet, and Amazon. Then you take a look at Tesla. It's up 51%. Nvidia and Meta have more than doubled. So what has been going on? This is the mirror image of what we saw last year when tech got obliterated and we saw energy soaring. Well, it comes down to market concentration. Actually, over the last couple weeks, there have been price cuts, Fed price cuts, Fed rate cuts priced out of the market. So the market is no longer expecting a hard landing. It's expecting more of a soft landing. And in this environment, it's thought that the mega caps will do a little bit better than other things. Now, this is a Nasdaq 100 versus a Nasdaq Composite going back about 30 years. And what stands out are a couple things. First of all, the chart is from the lower left to the upper right. This means that over time, the Nasdaq 100 has been gaining over the Nasdaq Composite, which has about 3,000 issues. There are a number of reasons for this, and part of it has to do with market superstructure we don't have time to get into, but nevertheless, the trend is already up. Secondly, we can see within this band, we kind of go within a range here. Right now, we are at the upper end of this band, meaning that the Nasdaq 100 is more in favor than it would have been otherwise at the bottom here when you had the Nasdaq Composite more in favor. But look at this. This move here stands in stark contrast to what happened in the dot-com bubble and crash. That was a huge outperformance by the Nasdaq 100 there in just a handful of names like Cisco, Oracle, Intel, some of them we know. Yahoo was one of them back in the day, even WorldCom, which ended up being a fraud. But nevertheless, once that was cleared, we kind of settled back into a range here. So I just want to show what's possible. We are nowhere near yet back in bubble territory, and probably a little bit early for that anyway. I do want to show you what's going on also now that the Fed has paused. Now, historically, when the Fed pauses, that does give the market a little bit of impetus to keep rising, and it's a little bit non-intuitive. Here's the Nasdaq 100 going back 20 years, and the Fed paused in 2006, in mid-2006. And then from that time forward into the global financial crisis, stocks actually rose into the time that the Fed made their first cut, which is somewhat not intuitive. You would think cutting, well, that's going to actually help the markets out. But I'll tell you what, guys, it was a signal that there was a hard landing to come. So that was actually the beginning of the end there. So suffice to say, now that the Fed is on pause, stocks could easily rally as long as the Fed remains on pause. Will that be a month, 2 months, 3 months, 6 months, a year? Just want to point out that these things tend to run longer than we normally think about. So this could be a 3-year cycle, of which we're maybe only in the first half of right now.
Interesting to get that historical perspective. Jared Blickery, as always, thanks so much for that. Well, we are just getting started here on Yahoo Finance Live. Coming up, the debt drama persists as the deadline looms. We're going to break down what kind of market impact we could see if lawmakers breach that X date. Plus, the next round in the battle of Disney versus DeSantis. We're discussing the financial impact to Florida, or at least that the Florida could be facing. And a new warning from the Surgeon General of the risks social media poses to our youth. We're going to be speaking to Dr. Vivek Murthy later in the show. We'll be right back.
Stocks moving lower today after President Biden's meeting with House Speaker Kevin McCarthy did not make much progress, it doesn't seem, on the debt ceiling negotiations. McCarthy, though, did announce that staff meetings are going to continue, and he does expect to speak with President Biden every day until a deal is done. We want to bring in Sam Stovall, a CFRA Research Chief Investment Strategist. Sam, it's great to see you here. So some losses in the markets today, but up until this point, and really largely speaking, the market has been very resilient. Why do you think that is? And what biggest lessons do you think we need to learn from 2011 in terms of the volatility that we could see play out in the market?
Hey, Shauna, good to talk to you again. Well, I think that most people on Wall Street think that cooler minds will prevail. We've had 20 government shutdowns since 1976. And the market basically yawned before, during, and after those shutdowns. This obviously is of greater concern should there be a debt crisis and certainly a debt default. But again, I think people are not expecting that. In terms of revenues, we've got at least 3 times the revenues to cover the interest expenses. So 14th Amendment basically says, no, you got to cover that. You could end up causing problems with other payments from the government, but we probably would not end up with a debt default. But should the worst happen, history then tells us, watch out, because we could enter into or close to a new bear market with the October low being taken out, because back in 2011, the S&P fell 19.5%, all sizes, styles, sectors, and 97% of sub-industries fell in price, with only gold, restaurants, and electric utilities being in positive territory.
Sam, we've heard the comparison to 2011 over and over. From a market perspective, though, is that where we are right now? Or is there a sense that things are a little more urgent this time around?
Well, I mean, I think that it was the first time that we had the U.S. government debt be downgraded. It ended up being a near bear market. I think certainly what is occurring now is of a challenge as well, because we are in a bear market environment right now. Back in 2011, we had been emerging from that mega meltdown of the financial crisis. So we were in a bull market mode back then, giving back much of those gains. Here, we're still grinding our wheels in a bear market environment, but within 4 percentage points of a new bull market. So, yes, there is a lot to give up this time around.
Sam, is there much upside potential if we do get an agreement, or is much of that already priced into the markets in terms of the catalyst?
No, I think just take a look at what happened last week when we had the growing optimism that there would be some sort of a compromise. The flip side took place, meaning that we ended up with all sizes, styles, and 7 of 11 sectors in positive territory. Best performers were communication services, consumer discretionary, and tech. And investors were rotating away from the safe havens of staples, healthcare, utilities. So I think what we saw week to date through last Thursday was a very good idea of what we will get when a compromise eventually arrives.
Sam, let's talk about Fed policy here. You say CFRA's base case here right now is that the Fed has ended its rate hiking cycle. We heard from Minneapolis Fed President Neel Kashkari yesterday saying that there could be a pause, but that doesn't mean another hike isn't off the table here. Does that put you pretty much in a holding pattern?
Yeah, in a sense it does. What would happen is basically having a skip situation where you don't do anything at the June meeting, but then maybe you raise rates at the next meeting. Our belief is that they're probably not going to be doing something like that, because the implication is to the marketplace that they're not really sure what they're doing. So I think that because of the reminder that they don't want to make the mistakes of the 1970s, because the data has come in stickier, and because of all this Fed speak, there's probably a growing likelihood that we will see an additional rate hike in June. And that, as Jared was mentioning before, we usually have a pause period, but on average, that pause lasts 9 months. And in that 9-month period, the S&P has gained an average of 13%, rising in 5 of 6 observations since the late 1980s.
Sam, what about the odds of a cut before year end? Where do you stand on that? What do you think the Fed needs to see in order to do it?
I think it needs to see a lot of problems if it were to do it this year. Our expectation is that they're likely to cut interest rates in 2024, but not sooner, again, because of the potential flip-flopping that took place in the late 70s that they don't want to replicate. So I think that they are either on pause or will at the end of June, and then they're going to wait until maybe even the second quarter of next year before they start to cut rates, which will add to the volatility in the market during this traditionally seasonally challenged period.
So let's talk about positioning in the face of that. You've highlighted specifically the tech sector, saying in a period of rising risk of recession, investors will lean on the group with growth potentials. Feels like tech is getting back in favor again right now, but what are some of the names, what are some of the spaces within the tech sector that you like right now?
Well, yes, we do like the tech area. Our belief is that, sector rotation goes from first to worst, meaning the better performers in a down market tend to be the underperformers in the subsequent year. And tech was one of the worst performers, so they tend to bounce back in that subsequent positive year. Those groups that have the highest CFRA stars rankings are application software, IT consulting, semiconductor equipment, systems software, and hardware. So a lot of these big names are in that group, but also looking for a resurgence in some of the semiconductor names as well.
Sam, what about valuations, though? Because when you compare it to history, it does suggest that valuations are stretched at this point when it comes to tech.
Well, not by much. I mean, when you look back to 2000, a lot of people thought tech was cheap, trading at 60 times forward earnings. Right now, the tech sector is trading at PE of about 22 times forward, which is basically about a 17% premium, but that compares with an 11% premium for the S&P 500. So on a relative basis, tech is actually trading at a single-digit premium. So I think that we could end up digesting some of the recent gains. We had the RSI above 70, full stochastics above 94. So I think possibly we're likely to digest some of these gains. But our belief is that for the coming 6 to 12 months, tech will still be a good place to be.
All right, Sam Stovall, CFRA Chief Investment Strategist. Thanks so much.
Thanks, Shauna.
Well, Palantir is one of the top trending stocks on Yahoo Finance all day. The stock soaring as Cathie Wood picks up shares, or more shares, I should say. Yahoo Finance contributor Remy Blair is at the New York Stock Exchange with more on that.
Well, in today's session, we saw shares of Palantir rally and soar to hit new 52-week highs. Ahead of the closing bell, we are seeing Palantir Technologies shares up, but we are well off those highs, above $13 a share. And as you mentioned, Cathie Wood's ARK investment keeps adding Palantir shares. The latest purchase adds over $4 million worth of shares across multiple funds, and this does include ARK's Innovation ETF, as well as FinTech ETF, and ARK's Next Generation ETF. Last week, ARK Investment added 1.26 million shares of Palantir across several funds. And elsewhere, Palantir is in the spotlight amidst reports coming out from the UK. There are reports that the company may cut by a little over 8% of its UK workforce by pruning as many as 75 positions over in London. And separately, fashion retail chain C&A and Palantir are teaming up on an AI model to help optimize the retailer's supply chain by speeding up the inventory restocking process. Ahead of the close here at the New York Stock Exchange, we are seeing trading volume for Palantir Technologies 3 times the average volume.
All right, thanks, Remy. Well, coming up, we are diving into a few stocks that you maybe should buy and a few to avoid as you try to position your portfolio. Stick around. Big story today, Apple's multi-billion-dollar deal with Broadcom to make chips in the U.S. Taking a look at how chip stocks are trading today. A bit of a mixed picture here, but you can see Broadcom, one of the winners on the heels of that announcement, with about 30 minutes to go until the close of the trading day. Well, regaining some of that momentum after China's move to ban Micron put pressure on the sector yesterday. Our next guest, though, does see some opportunity in this space with one of his picks. For that, we want to bring in Jay Woods, Freedom Capital Markets Chief Global Strategist. Jay, it's great to have you here on set. So your pick, you have a couple picks for us today. One of your picks, Micron, stuck out to us given the news that we got just a couple of days ago with China's ban. Why do you like it?
All right, I'm a technician first. I look at price activity, and what I see is a very interesting move that happened before the China news. It was actually Japan news, which was very positive in the stock last Thursday, and the stock popped. And where did it pop? It popped above a major resistance level. This area of 65 had been tested so many times and failed, but each time it failed, it made a lower high. So that was positive action. So it had a nice rounded base. You look at the sector, it's been the laggard, and all of a sudden it popped. Then yes, the China news came out, got a little concerned. How did it act? It reversed, got back to 65. Old resistance became support, and now it's trading higher in a very mixed market. So the action is positive, above 65. I want to be long this stock.
So, Jay, you're looking at the technicals, but let me just ask you on Micron specifically. I mean, we heard yesterday from the company about the potential impact. It's just over 10% of revenue when you think about how much of the revenue they get from China. In light of what we now know in terms of the ban, does that change your case at all? And does that create a bit of a overhang on the stock?
The news at first had me worried. I'm like, this level is never going to hold. But I look at the rest of the sector that has more exposure to China than Micron. Yes, Micron's been singled out, but you don't know if Intel is going to be targeted or Broadcom. You have to kind of go with what leads. And to me, price continues to lead. And if we're above that 65, it absorbed a major shot across the bow. And to me, the price action still speaks louder than the news in this case. And that news was scary. I'm not going to deny that.
Jay, one of the other picks that you have for us today, you actually like how cybersecurity stocks may be positioned at this point. What's your play there, and why do you see upside? Yeah, cybersecurity has been kind of a laggard. It's been trading sideways. I look at not just one stock within the sector, but the ETF, and the ETF is Hack. It was trending down for over a year. And the first thing that changed is, one, it stopped going down. So to me, positive price action. We saw the negativity come out. And what's it been doing since? It's up year to date. It's been trending sideways. And once again, every time it goes up, it fails around this 48.5 level, and it makes a higher low. Then you want to look under the hood. What are the parts driving it? And you look at great charts like CrowdStrike, Fortinet, Cloudflare, and then after the bell today, we have Palo Alto Networks. It's a little shaky on the chart. Let's see how they do. They've done extremely well after earnings. 8 of the last 10 times they've traded higher. So that's a positive. And then Zscaler, another of the top 10 components, reports next week. So right now, I think it's knocking on that resistance level, about to break out. And we have two key earnings that could take us above. So if we can get that to trade above 48.5, close there, I think you have a nice 10 to 15% higher over the next 6 to 8 weeks.
Before we go to some of the stocks that you're staying away from, Jay, I have to ask you about the one you're watching very closely, and that is ARK. A little surprising to me, I will say. Yes, it is up about just over 25%, nearly 30% on the year, but it's fallen so much, and I have to wonder what you see as the potential catalyst that could push this to the upside. Maybe not at levels that we saw in 2020, but certainly not how far it fell last year.
Oh no, the stock was down 80% peak to trough, and now it's rebounding. It's having a nice year, and it's doing it without the euphoria, without the hype. As you mentioned, Akiko, we're not seeing everyone talk about it, and I kind of like that. It's being forgotten to an extent. Now I know Remy talked about Palantir. Once again, just like in Hack, look under the hood. What are the stocks that are leading? Her top 10 holdings are starting to look very nice, whether it's DraftKings, Palantir, Shopify, and then the stocks that have been beaten down, they're holding on relatively well. So I don't see much of a downside. And then what I like, risk-reward setups. So it stopped going down, it's basing higher lows, and now it's trading above its 200-day moving average. It did it to us once before, it failed, so you get stopped out on a loss. But the risk-reward setup is nice. It's not euphoric, it's not going to act like it did years ago, but what we have is a very potential nice upside, and in some stocks within the sector look very sharp to me as well.
Jay, let's take the flip side of this. Stocks that you're saying to avoid right now. One of those is Occidental, a name that Berkshire's Warren Buffett likes. We know that Berkshire just upped its stake to over 24% in this company. You're not buying the hype, though.
No, Occidental was the best performing stock in the S&P 500 last year. Everyone is familiar with Warren Buffett owns over 20% of the company. Back when they were in Omaha a couple weeks ago, he was asked, are we going to take a bigger stake in it? And he said no. He kind of punted on the question, and then let's look at the technicals. We have got a major topping pattern going back, 8 months to when the stock made its peak, and now every time it gets to this 56 to 60 area, it's support, and that support has been Warren Buffett, and the more often that support is tested, the more likely it's going to fail. You look at the sector, it's kind of toppy right now. If we see crude break out to new levels and we get a run in the summer driving season, then maybe the stock holds on. But to me, it's a strict avoid. You see a topping pattern, and if we break and close below 56, you have a lot to reverse. So that scares me a little bit because we don't want to be in a stock that's breaking down. If you play it safe with the stop at 56.
Finally, Jay, the other one that you're staying away from is ELF. It has had an incredible run, and I wonder how much of that is about just, sort of simply looking at the technicals here, seeing that it is up significantly, or is it about concerns on the business strategy here and how much of a pullback they're likely to see?
Well, the business strategy has been working. I mean, I have a daughter. I know the store. It's phenomenal. It's up 300% year to date, and it looks like it's tiring. And it's got earnings after the bell. One, I try not to play stocks into earnings, and the tremendous run is there, and it looks like it's tiring out. It just broke a small level, nothing major, in a consolidated triangle, which is a continuation pattern to the upside. It's right on its trend line. It's right on its 50-day moving average. Given the run that it's had, it's really going to have to crush it this afternoon in earnings to see it make new highs. Could it happen? Sure, it could happen. But this is one I would avoid, and the risk reward is more set up to the downside. We haven't seen many stocks beat and go down. Walmart did. But with this stock, if you have profits, if you made 300%, I would probably take them in and sit out this earnings period. And if it can gap higher, then yes, you may see another run. But right now, the risk-reward setup is, to me, something you want to avoid.
Yeah, a lot of that good news might already be priced in, given that 300% increase over the last year. Jay Woods, great to have you. Thanks.
Great to be here. Thank you.
Well, with rapid developments in artificial intelligence, the White House is launching a new roadmap for the emerging technology. The Biden administration releasing an updated national AI research and development strategic plan today. That's updated for the first time since 2019. And it outlines 9 strategies and goals for federal investments. That includes advancing foundational AI capabilities and ensuring the safety of systems. The Office of Science and Technology Policy putting out a new request to the public today. The government wants public comment on critical AI issues. The end goal will be to help update U.S. national priorities and future actions on AI. This includes mitigating risks as well as protecting individual rights and safety. Lastly, the U.S. also highlighting in a new report the risks and opportunities related to AI in education. The report recognizes AI can enable new forms of interaction between educators and students, but also it underscores the risks, including algorithmic bias. And while the White House charts the path forward on AI, Microsoft is expanding the AI ecosystem to its platforms. Here with more on the details is Yahoo Finance's Dan Howley. Dan, a lot of announcements coming through that certainly could lead to AI assistance while using Microsoft products.
Yeah, that's one of the main products that they announced is this new Windows Copilot. What they're basically saying is a new kind of AI assistant for Windows 11. It's something that'll live in the taskbar. You'll open it up, and then on the right side of the screen, it'll show up there, and you'll be able to interact with it. ask it questions like you would Bing Chat, but then also ask it to do things like adjust some of the settings in Windows. It can pull in information from other apps and quickly summarize them for you. You could drop a file in there and it'll do that. Anything that you really can think of right now when it comes to chatbots, this can do it and more. And so this is one of the bigger announcements we've seen. Microsoft previously had Cortana. That kind of got the axe. This is clearly going to replace that, or has replaced that. That was done off a while ago. But they also announced a few more pieces of software. That includes the Azure AI Studio. That's something where companies will be able to take their own data and dump it into a kind of Copilot chatbot and create their own. It's basically Microsoft saying a kind of app that you would be able to use. So if you are a company and you offer your employees multiple health plans, and you're a particular employee, you're looking for the health plan that covers glasses, you would be able to type in, show me the health plan that covers eyeglasses, and it'll spit that out for you. This way you don't have to go through a ton of documentation. You're able to get exactly what you need right from that. So that's one of the other developments that we saw. And then finally, the big announcement, maybe one of the most important announcements, is that ChatGPT, the base search engine, the default search engine, is now going to be Microsoft's Bing. So that means that they'll have Bing in front of more eyes. It'll be the default out of the box for subscribed ChatGPT Plus users, and then free users will have to turn on a plugin, but then they'll just be able to use Bing as the default. That's big because Microsoft says that if they get just 1% of market share in the search market, it could be worth as much as $2 billion in revenue. So, if they get it in front of more people, all the better.
Certainly would be huge for them. We know that they've been struggling to regain any of that market share. Dan, there was also a big announcement from Apple today, unveiling some details around its next Worldwide Developers Conference next month. What should we expect?
Yeah, WWDC is going to be on June 5th. That's going to be in Cupertino. They're going to have a live event as well as streaming it online. And they showed off kind of a little app teaser GIF of the Swift logo, but it looks like a kind of like lens goes over it, and it's, you think, hinting at the idea that they'll eventually have their VR AR headset, and that's something that's been really heavily rumored to be coming at WWDC. Could be $3,000. Look, the AR VR headset space has not been doing particularly hot. I mean, it's not exactly falling apart, but it's been kind of overtaken, the idea of the metaverse, by generative AI at this point. So if there's anyone that can breathe life into it and then actually get people more interested in it, it would be Apple. So we'll find out on June 5th.
All right. Dan Halley, thanks so much for that. All right, we're also tracking the real estate reality here. U.S. new home sales rising unexpectedly in April, hitting its highest level in just over a year as inventory issues push buyers to new homes. This comes as Americans also navigate elevated mortgage rates, making real estate a pricey game to play. Joining us now, NestSeeker's international chief economist, Aaron Sykes. Aaron, it's great to see you here. So certainly an impressive number when it comes to new home sales. What does this really tell us about the current dynamics at play and the edge that it seems builders do have in this market?
Yeah, well, it's finally nice to report some good news in the housing market. And I'm excited to see this, particularly because typically these numbers are very lagging. This is numbers from April, and we've seen a lot of traction via boots on the ground agents in the last month or so saying that activity is picking up. So this just reiterates that that is actually true. And I think what happened here is that developers are industry insiders. So this number that is 13%, or the best number in 13 months, it's developer-owned property selling to buyers, not resales in the market. And that's particular because these developers, they're the industry insiders that knew what was coming. They saw the foreshadowing of the current market, and they reduced their prices and enhanced their different attributes in order to make deals happen. And we're actually seeing prices of new homes 8.2% lower than this time last year. So they really made quite a few concessions. Now, in contrast, independent sellers, those in the resale market, homes listed on MLS, they were holding fast for, those COVID highs. They thought that they could still get those numbers, but we've seen the price reductions kick in towards the end of April, throughout May, and now we're getting back on the same page. So we're seeing even footing between these new homes and resale homes.
Yeah, bottom line though, even though we're talking about a 13-month high, the reality is the supply just isn't keeping up with demand. That's certainly, as you point out, why we're seeing so many new home sales, or that pace accelerate. What's the timeline look like right now? When you think about the mismatch between supply and demand, I mean, how quickly can we see that inventory build up from the new home side?
Yeah, so it's really tough because right now developers are not pulling the trigger on new single family home construction. And that's because materials are still very high and also labor is still costly. So they don't see that margin. Developers are not fully altruistic. Just because there is a shortage of inventory in the market doesn't mean that they're going to build things for cost. So they need to make sure that there is meat on the bones in order to motivate them to build these new homes. And that said, there is a dearth of supply in the multifamily market. So when we look at new home starts, we typically see that number driven by multifamily, and we've been seeing the single family pull back for quite an extended period of time, and that's where the true inventory shortage lies. So you need to see that pick up, and then you'll need to see multifamily pull back a little bit. And the reason why we're seeing so many people interested in multifamily is because condos tend to be less expensive, less square footage than single family homes, lower maintenance. People are splitting their time between two different locations now with the remote work from home. And unfortunately, people are getting into the perpetual renting cycle. When you look at the potential of having a 7% mortgage versus paying the highest rent in history and potentially never getting out of that rental cycle and never owning a property and just paying your landlord's mortgage, 7% is not so bad. Ask our parents, they were paying 18%.
But the problem is, though, Erin, a lot of people don't believe that, or a lot of people don't see that, at least right now. So what do you think mortgage rates need to fall to in order to spur that activity? Are we talking 6% or lower?
So typically we say 6% is that tipping point. Anything above 6% is kind of high, anything below is a win. But if you look over the 50-year historic average, we see that number is 7.77% as the average mortgage rate. So really anything below 7.77% is still truly a logical number to get into for a 30-year mortgage. And I think people are coming to that realization. They were very hesitant to pull the trigger and make offers on homes the last 6 months, but we've seen that activity pick up because we keep hearing the Fed over and over again say, hey, we're not going to drop these rates until we see 2% sustained inflation. That just doesn't mean 1 month of reading at 2%. That means 3, 4, 5 months reading at 2%. That means these rates are not going anywhere anytime soon.
Not exactly what a lot of new first-time homebuyers want to hear. Erin Sykes, good to talk to you today. Really appreciate the time.
Florida Governor Ron DeSantis has enjoyed a pretty strong track record when it comes to the state's economy, despite a more lackluster picture on the national front. However, though, the ongoing battle with Disney is casting a dark cloud on the Florida governor. Here with more on this is the Yahoo Finance's Rick Newman. Rick, up until now, I think DeSantis has proven that he does have that strong track record on the economy. Do you think this feud with Disney, is that changing the picture?
Well, I'm going to say Florida has performed well while DeSantis has been there as governor since 2019. You can get into the question of whether he deserves a credit for that or not. So I've been crunching the numbers, and Florida has outperformed the country as a whole on job growth and on wage growth since DeSantis has been governor. And one of the most notable things about his governorship was he generally kept businesses open. He did not enforce lockdowns during COVID the way we did here in New York, for example, the way some other states did. Now, COVID was not as acute in Florida as it was in some other places at those early months. So Florida, to some extent, could get away with that. But if it were just for that, I mean, Florida looks good. Economically, it looks good during the last several months. And yet here DeSantis has the CEO of Disney saying that he has anti-business policies. It's not just Disney, by the way. There's a lot going on below the surface that might not yet get national attention, but I think probably will. The NAACP has actually issued a travel advisory saying Florida is not necessarily a comfortable place for Black Americans to go. That has to do with some ways that DeSantis has forced revisions on Florida's racial history. You have some Hispanic truckers now saying they want a boycott of Florida because of this new law DeSantis signed that's meant to flush out undocumented immigrants from companies with more than 25 workers. That means you have to go in and verify that all of your employees are legal workers there. There are some reports that businesses are actually losing workers. So it seems to me that the way to think about DeSantis is he might like to tell people he's a Reaganite Republican, but he is not. He's got these Trumpy America First policies, and it's all about the culture war, about battling illegal immigration, and that trumps everything. So he wants businesses to sign up to his war on woke capitalism, and for businesses that don't do that, he has indicated he will punish them, which is what he has started with Disney, which is a battle he might end up losing, by the way.
Rick, we're getting reports here that DeSantis is likely to announce his candidacy for president tomorrow. We were talking yesterday about some of the big name business leaders that are backing potential presidential candidates. It sounds like he's got a big one coming tomorrow.
Elon Musk. I didn't see this one coming, but it makes sense. And the one thing I think about so Elon Musk is going to host this announcement event. It's going to be a video event on Twitter, which Elon Musk now owns. This does kind of make sense. So Elon Musk really fought back against lockdowns during COVID, and he actually violated county law in California by keeping one of his Tesla factories open when the county said they had to shut down. And he dared county authorities to come and arrest him. And that was a pretty big deal at the time. So it makes sense why Elon Musk would be, I don't know if we're yet saying that he's endorsing DeSantis, but he is hosting him for this kickoff announcement tomorrow. And they'll probably talk about shutdown policies and things like that. Now, it's a different thing altogether. The big question is, would Elon Musk back him with money? Elon Musk, for his weird interest in politics, as far as I know, has not really given mega donor amounts of money to political candidates, by which I mean tens of millions of dollars. He could do that, but we will see if he actually wants to get that involved.
And we will see if he backs it up with money, but certainly hosting this, you think, is some sort of...
Well, I mean, it'll make it more of a media circus, that's for sure, and it will draw more attention to DeSantis.
Yeah, it could benefit both there. All right, Rick Newman, great stuff. Thanks.
Yep, thanks.
Well, coming up, we are counting down to the closing bell here on Tuesday afternoon. More of Yahoo Finance coming up. There's a closing bell on Wall Street. All three of the major averages closing Tuesday in the red. You're looking at the Dow closing off just over 220 points. S&P and Nasdaq both closing off over 1%. The Nasdaq, the worst performer of the three, off just about 1.3%.
Let's check in on shares of Apple and Broadcom after the two companies announced a new multi-billion-dollar deal. The agreement will see the chipmaker supplying Apple with 5G radio frequency components and wireless connectivity components in the U.S. Apple CEO Tim Cook saying that he's thrilled to make the commitments that harness, in his words, the ingenuity, creativity, and innovative spirit of American manufacturing. All of this to say, Shauna, bottom line, Apple is looking at more chips here in the U.S. to reduce its reliance on China.
They certainly are, and this was largely expected just given the fact that they are pivoting away from Asia. They hadn't made that announcement of their commitment to the U.S. and investing here. In terms of what this means for Broadcom, yes, we did see a bit of a move higher when it comes to Broadcom's stock today. Apple did close off just about 1.5%, but Broadcom was in the green. In terms of the degree of this really being a catalyst for the future, a lot of that remains to be questioned. We heard that from Bob O'Donnell last hour, just in terms of exactly what this means. For right now, we know that Apple is Broadcom's largest customer, accounting for about 20% of their revenue in the last fiscal year. So certainly that explains the reason why we're looking at shares closing up just over 1% today. Well, shares of Zoom are closing the day in the red despite reporting fiscal first quarter adjusted earnings and revenue that topped Wall Street's expectations. The online video conference company saying that a plan to grow sales with enterprise customers may not proceed as quickly as expected, which could be playing into the market action this afternoon. We know that data point missed the street's expectations on the earnings call, on the earnings report last night. But again, a dip of 8% in Kiko just shows that the street is concerned about the trajectory of this company, what the growth opportunity looks like for Zoom, given the fact that many businesses have brought their employees back to the office.
Yeah, I mean, that is the constant overhang on this stock, which is that, can they continue to perform at the type of pace that they did over the last few years, given the current office environment? Remember, they were a huge beneficiary of work from home. The other concern, though, is this constant we have heard, Shauna, which is about competition. Microsoft, a big one here. They recently launched a premium version of their Teams product. It's not just that. They've also got AI integrated into it. And the concern here increasingly is to what extent Zoom can compete against competitors who are much more well equipped, but also in this environment where enterprise just isn't investing as much. And you see the stock today hit down about 8%. Well, Yelp shares higher today after activist investor TCS Capital Management confirmed reports that it has built a stake of more than 4% in the company. It's asking Yelp to explore strategic alternatives, including a sale, and that led to a big pop on the stock, up nearly 6% in the session. Shauna, an interesting stat, though, as I was reading into this, is when you think about activist campaigns, they have dropped this year when you compare it to where things were last year. But certainly this is one to watch because this isn't the first time that Yelp's been targeted.
It's not the first time. They were targeted just a couple of years ago, back in 2019. And that has the street questioning what is different this time around. KeyBank was out with a note today saying that this newest argument, they're curious in terms of how this differs from what we heard from SQN, who did call for that sale not too long ago, just a couple of years ago. When it comes to some of the changes that are needed, Baird is out saying that once again, Yelp is in the crosshairs, but it is better managed this time around and on stronger footing, which you think would give Yelp a little bit of leverage. But obviously lots of questions about what the future of this company looks like. And you're right, far from the first time that the company has been under pressure from activist investors. All right, getting to the debt ceiling debate, both Republicans and Democrats are trying to put a positive spin on those talks, but there's still no deal. New analysis from the Bipartisan Policy Center found that the looming X date, the date that the U.S. can no longer pay its bills, will fall between June and early August here, with an elevated risk of hit falling here between June 2nd and the 13th. Let's talk about this. We want to bring in Shai Akabis. He's Director of Economic Policy at the Bipartisan Policy Center. Shai, it's great to see you here. So certainly some concerning notes in this most recent report that you just published. We are days away to really start skating on thin ice. Just how dire is this situation, and when should we really start to worry just about the Treasury's ability to pay those bills?
Yeah, it's great to be with you. You know, we shouldn't be complacent because we are within a week or several weeks of not meeting all our obligations as a country. And that has never happened in the history of the modern United States. And it could lead to really catastrophic consequences. On the other hand, we've seen this debt limit drama play out time and time again. And every single time Congress has reached an agreement and extended the debt limit in a timely manner so that we don't see those worst consequences. I am cautiously optimistic that they will get there again. There have been positive developments in the negotiations. I think the contours of a deal are clear, and now it's just a matter of striking the details so that they can sell it to both conferences, pass it through the House and the Senate in time to avoid the X date, as we call it.
With that said, we keep talking about the X date. The reality is this needs to pass through the House, right? I mean, if we're talking about staying through the Memorial Day weekend potentially. You look at where the timeline is right now. Yes, we are still just over a week out from the X date, but how do you see this playing out over the next 9 days? Because if we're talking about walking right up to the line, you got to see a lot of jitters creeping through the market, right?
Absolutely. Congress rarely gets its homework done early, and this is just on display again. We're going to be coming up to the wire here. We're already at the wire. And now the question is, can the two sides finally come together in the next 24, 48 hours, shake hands on a deal, sell it to their conferences, get it drafted, get it passed, and get it signed by the president? That's a lot of steps. I expect that they're going to have to work through the weekend in some shape or fashion in order to get this done. We don't know exactly when that X date will arrive, which is an added element of uncertainty here. Secretary Yellen has said that it could come anytime after June 1. And that's frankly very consistent with what we found, that June 2nd to June 13th period presents a really elevated risk. Each day that we go into that period means that we are taking the risk of defaulting on some of our obligations as a country. Again, we should not take that lightly, but ultimately there is time still for the two sides to reach a deal and get it signed into law in order to avoid these worst outcomes.
Sean, when it comes to potentially reaching that X date or getting close to it, there was in your analysis here that maybe that X date could be pushed out if they're able to make it to June 15th. Talk about the tax revenue, how that plays into that, and how much that could potentially just move that X date or postpone it.
Yeah, so this is different from a usual deadline because we're dealing with hundreds of billions of dollars that are coming in and out of the government each month and trying to project when that's going to deplete the reserves that the Treasury has on hand. We expect there's a good chance that will happen during the first part of June. But if it doesn't, quarterly tax receipts come into the Treasury around June 15th from corporates and individuals who are paying quarterly. And that would help buoy the Treasury for a little additional period of time to allow them to continue meeting all obligations while Congress continues to work this out. Now, hopefully we won't get there. And frankly, we may not even get there from a Treasury cash perspective because they may run out before then. But if they do, that would buy a little bit of additional breathing room. So that shouldn't be a reason for the negotiators to take a couple-week vacation and come back and do this later. But it might get to the point where we have that additional period of time and the X date comes later. That's what's all confusing about this, is because policymakers don't have that firm deadline to work against, and that's what they're accustomed to.
Yeah, I mean, that's a lot of hope riding on the process. I mean, what does that buy you if we're talking about the X date not being at June 1st?
Well, I don't think it buys you much. Ultimately, the two sides need to reach a deal, and they know what the outlines of that deal are. It's going to be something on spending caps for a certain period of years, and it will definitely affect domestic agencies. It might also affect defense. We know that they are in agreement on rescinding certain monies that have been allocated for COVID that have not yet been spent. And there's a couple other categories of things that they're within range on finding agreement. So that's what the deal is going to look like. The details are important, but ultimately, if they've narrowed the gap from what the House passed a few weeks ago and what the president proposed in his budget to where we are today, they've gotten 95% of the way there. It's just closing the deal and then getting the two sides to agree. So that's why I'm optimistic that they can get there. But again, we need to be aware of the consequences that are sitting just a little over a week away, where millions of people across the country might not receive the benefits from the government that they're expecting on time. If that happens, we could see downgrades from credit rating agencies. We could see plunges in stock markets. We could see interest rates rising. We don't know that any of those things will happen because we've never been there before as a country. It's uncharted territory, but the consequences could be really severe.
Talk about those consequences. Lots of comparisons to 2011, how today differs from what we were looking at just about 12 years ago. Do you think it will play in Biden and McCarthy's favor, just in terms of the fact that neither side, both are under a tremendous amount of pressure, but when it comes down to Democrats and Republicans, neither side wants to be blamed for this?
Yeah, nobody wins if we default on our obligations as a country. That would be a tragic scar on the reputation that we have globally. Neither side has an interest in getting there, but how we reach from where we are today to a signed bill on the president's desk is a challenge, and especially given the period of time that we're working with. So if this were up to a unilateral actor, sure, there would be no chance we would default. The reason why we're in this situation is it depends on the Republicans and the Democrats and a lot of cacophonous voices within each of those conferences. Again, I have confidence that we're going to get there, but we've hit several bumps along the way. We may hit one or two more, and we'll just keep our fingers crossed that in the next several days, they'll make that progress that they need to reach the deal.
Certainly a lot of posturing going on. Shaya Kabbas of Bipartisan Policy Center, thanks so much. Well, coming up, we are recapping some of today's top trending stories and trending tickers. Stay tuned.
BlackRock unveiling two new active ETFs at their media roundtable event earlier today. The new ticker is BINC for Flexible Income ETF and BLCV for a Large Cap Value ETF. Help strengthen BlackRock's expanded investment platform. Yahoo Finance's Ali Kanal and Josh Schaefer were at the event and joins us for their takes. Ali, let's start with you.
Well, the thing that stuck out to me, Akiko, is that a recession is not necessarily guaranteed, especially a deep recession. We heard from Rick Reeder. He's BlackRock's chief investment officer of global fixed income. He said the fact that we have unemployment so low, 3.4%, wages are strong, the housing market is recovering. We have really strong home builder data. We're seeing improvements on the residential side, strong CapEx. That's all boding well for the current economic environment. And he's pretty optimistic optimistic that we might not see a recession. And from an investor perspective, that's something that is really encouraging, and that therefore they are encouraging those clients to get in the game.
Well, it's interesting too what Reader was saying when then you relate that to Fed policy and sort of what we're seeing with Fed markets. So they're in the camp that they think that there's going to be a pause in June, and they're in the higher for longer camp, and they think that's what Powell is sort of signaling here, that there's going to be rates are going to stay at the same rate for a while. They don't see rate cuts in 2023. They see steep rate cuts coming in 2024. And that's actually moves we've seen in the market as well. When you take a look at the projections from the CME group, it has now come down. There was a lot of rate cuts initially projected at the end of this year. Those projections have started to come down, and that sort of comes in line with when we're talking about the recession. If we were going to go into a deep, deep recession, it was going to be aggressive, you would then probably think maybe the Fed does cut, right? And the Fed cuts earlier. So they're sort of in line there with saying they don't see a deep recession, and they think that that means that the Fed can keep those interest rates higher and let those interest rates sort of go to work, if you will, Shauna.
Yeah, that higher for longer period. So how does this then playing into their strategy, given the fact that they see this potentially higher for longer interest rate environment? Still a lot of uncertainty, though, about exactly what the economy is going to look like. So what does that mean for their funding positions?
Yeah, so obviously when you talk about large cap value, that means that they're going to be playing for some kind of slowdown, right? They're still looking at those kinds of sectors that you'd look at when it comes to a slowdown. But I thought it was interesting they pointed out, so say consumer staples, utilities, healthcare, right? Those are classic plays that you might look for in a recessionary environment. But they say consumer staples are essentially priced too high right now. They're already priced in, if you will. People have already bought those stocks. You've kind of seen that play out when you look at earnings too. Look at like a Procter & Gamble off over the last month since reporting earnings. But then you spin that forward into something like healthcare, Allie, and I thought it was interesting what they pointed out with healthcare there. They sort of see value there because people haven't quite bought yet, and they think that that could be a recession play in some ways.
Yeah, they said healthcare was cheaper and also really resilient during these times. They made some interesting comments, too, about growth versus value. Pre-global financial crisis, value performed very well and outperformed growth. But then when we had this period of ultra-low interest rates, we saw growth outpace value. And now that those interest rates have come back up, they're predicting that value is going to be really strong, especially in relation to growth.
Ali Canal and Josh Schaefer, thanks so much for that. Well, coming up, a new warning from the Surgeon General on the risks social media poses to our youth. We're going to speak to Dr. Vivek Murthy on the other side of the break. We'll be right back. Well, there's no question social media plays a major role in many of our lives, and it certainly includes the lives of young people. But should that be the case? Today, U.S. Surgeon General Dr. Vivek Murthy released a public advisory warning of the risks social media poses to our youth. And Dr. Vivek Murthy joins us now more to discuss this, along with our very own Anjali Kamlani. Good to have you on today. You had an op-ed in the Washington Post today where you specifically said when you travel around the country, the number one question you get from parents is social media safe for my kids? How does the advisory and the guidelines presented today make these platforms safer?
Well, this is absolutely the number one question I get, and it's from parents who are deeply concerned about the impact social media may be having on their kids, but who are also utterly overwhelmed with the fact that we have, for almost 2 decades now, placed the entire responsibility for managing a technology that's rapidly evolving and that's fundamentally changing how kids experience friendships and how they think about themselves. We've placed this whole responsibility on the shoulders of parents. What our advisory does is it helps answer that question, and it comes to 2 critical conclusions. One, that there is not, in fact, enough evidence for us to say that social media is sufficiently safe for our kids. But number 2, there's in fact growing evidence that social media use is associated with harms to our kids. This is really concerning to me because kids are not just smaller adults. Adolescents are at a critical phase of brain development where they're more sensitive to social pressure, social influence, and social cues. And all of those exist in overwhelming abundance on social media. And lastly, consider this. Kids who spend more than 3 hours on social media a day face double the risk of experiencing anxiety and depression symptoms. The average amount of time a teenager spends today on social media is 3.5 hours. So we have many kids who I worry are at risk. And that's why I'm issuing this advisory, because we have to take action to protect our kids now.
Dr. Murthy, Anjali here. Good to see you again. Talk to me about why you stopped short of really calling this a full-on problem. You seem to walk back, even citing dozens of studies about the relationship between social media and their negative impacts, but then saying that there may be, a problem with them. It can have a profound risk. So it seems like you're sort of tiptoeing around, and then to your point, not having enough evidence just yet, even though you cite so many. So what are you waiting for, really?
Well, so Anjali, as you know well, we have to go where the evidence leads us. And we would certainly like more data than we have. Part of the reason that independent researchers do not have more data is because they tell us they have not been able to get the full data from technology companies despite we're asking for it for years. But the data we do have is enough, in my mind, for us to take action. And what we lay out is that while there are some benefits that some kids get from social media, there are also growing evidence of risk of harm. And we need more data to understand exactly the full extent of those harms, to understand which kids are most affected. But what we really need to do now is put in place safety standards, the kind of standards we have for other products that kids use, like medications or cars or car seats. And in these products, what we do is we establish standards that are set by independent experts and that are actually implemented and enforced so that parents don't have to go and investigate these products, do their own chemical analyses, investigate the brakes of car systems on their own. In social media, we've got to do the same thing. These products are extraordinarily complex. They're rapidly evolving, and it's just too much to ask parents to fully understand exactly what is going on these platforms. That's why we're calling for action from policymakers as well as from technology companies in this advisory.
Dr. Murthy, I would think a lot of these tech companies would push back just a little bit, saying that they have taken into account some of the risks that are out there. They have put in place some uses in order to better control. They have the age limit, 13. Many of these social media companies require you to be 13 years old in order to go on the platform. They have said that they do work to try to limit some of their exposure there. What more specifically would you like to see be done here from those tech companies?
Well, a lot. It turns out that, yes, they do have a limit of age 13, yet somehow 40% of kids ages 8 through 12 are on social media. Rules don't help if you're not enforcing them. Second, though, these products have to be designed in ways that optimize and support the mental health and well-being of our kids. And what matters is the evidence that they work. It doesn't matter how many steps and programs we have in place. What matters is the proof that they're actually helping. And when we look at the evidence that's publicly available, we do not see that evidence that they are in fact safe for our kids. So until that's demonstrated, then I'd say that we have clearly not done enough. And finally, when it comes to transparency, no parent, and I say this as a parent myself, no parent wants to feel like information is being hidden from them when it comes to the impact these platforms are having on their kids' mental health. Yet independent researchers keep telling us they cannot get full access to the data from technology companies to understand that full impact. In my mind, that's simply wrong. That shouldn't be the case. So we need greater transparency from these companies.
Dr. Murthy, I know that you've probably heard this clip before, but I want to play for you the Facebook whistleblower talking about Meta in particular knowing about the risks. Listen to what she had to say.
Many of Facebook's internal research reports indicate that Facebook has a serious negative harm on a significant portion of teenagers and younger and children.
And I know that we also have heard the TikTok CEO talk about being willing to support more funding for NIH research in order to look at what you're talking about. But it seems like the problem solving for technology is more technology, whereas in other things that you've been able to regulate or warn about, and the country in general, take, for example, not just seatbelts and safety, but also drinking limits and smoking limits and the like, so age limits. So it seems like there isn't really a set way to enforce all of this right now. Are there thoughts that you have on how we can all, as a country, get our arms around this?
Well, sure. Well, without a question, this is complex. These products have evolved over nearly 2 decades now, and so getting our arms around them isn't going to be simple. It won't happen overnight. But we can use models from the past with past products. We can, for example, set the kind of safety standards that would minimize a child's risk of exposure to harmful content, risk of being harassed or bullied online, particularly by strangers. Keep in mind, 6 in 10 adolescent girls say that they've been approached by strangers on social media in ways that make them feel uncomfortable. We can also put standards in place that reduce the use of features that seek to manipulate children into spending more and more time on social media. And that kind of excessive use steals time away from sleep, which we know then has deleterious effects on the mental health of young people. So there's absolutely standards that we can put in place. We actually have to enforce them as well. And both parts of this need to happen. Again, this is not new. We do this for other products. It may be different how we do it for technology, but we've got to recognize that it is urgent that we act here. We are living in the middle of a youth mental health crisis in America that I have said is the defining public health challenge of our time. And the data is telling us more and more that social media may be an important contributor and driver of that youth mental health crisis. I believe it's our moral responsibility to address it with urgency. Kids need it, parents are asking for it, and as a society, this is what we've got to deliver.
Dr. Vivek Murthy, we appreciate you taking the time today. Our thanks to Anjali Kamlani as well. Well, coming up, we are joined by the head of artificial intelligence at Qualcomm to discuss opportunities and risks that come with AI. Stick around.
Stocks ending the day lower as some worry over the debt ceiling negotiations. Well, let's take a look at some of the top trending stories of the day. Tesla shareholders, they've been a bit concerned about Elon Musk's commitment to the company since taking over Twitter last year. Well, there's a new Axios poll out, the 2023 poll ranking the reputations of the top 100 companies on Americans' minds. So Tesla took a massive hit in this. They ranked 62nd this year out of 100 companies. Last year, they ranked 11th. Now, according to Axios ranking here, Tesla has a, quote, good reputation, but not very good or excellent. And when you take a look at some of the brands that did place in the top 5, excellent reputations, you're looking at Patagonia, number 1 spot, Costco, Deere, Trader Joe's, and Chick-fil-A rounding out that top 5. Prasto, let's focus on Tesla. The fact that we saw such a dramatic drop here with the company's reputation, not a huge surprise given what's played out over the last several months.
Yeah, a lot going here. I wanted to know one quick thing about the list. FTX was 99 and the Trump board was 100. So just noting that was part of the rounding out the list. But yeah, Tesla fell 50 spots-ish around that from, like you said, 11th to 62nd. You know, Musk's outspokenness on all things like labor, race, politics. George Soros even, right? This really kind of making customers feel that they don't necessarily want to be connected with him as a brand, with Tesla as a brand. What does it say about you? There's been talk, of driving Tesla like random red MAGA hat, right? That's sort of the kind of the feeling that, I'm not saying that's how it is, but people feel that way. But look at Twitter also too, right? Twitter down nearly 40 spots to 97th place on the list.
Yeah, and to me, what stuck out was that social media as a whole, right, has seen their reputations plummet. And it's not just the fact that Elon Musk took over Twitter. It dates all the way back to the 2018 Cambridge Analytica scandal, according to this poll. I also think of all the Capitol Hill testimonies that we've had, how there's been a lot of data leaks, privacy concerns surrounding companies like TikTok and Meta. So that was an interesting group that stuck out to me, especially as we have Meta developing their own Twitter competitor. We have new entrants like Be Real, which my friends and I have dabbled in. So you wonder if these legacy social media companies could be on the outs as these trust concerns weigh heavy on the minds of consumers.
TikTok down there hanging out with Bitcoin too.
Yeah,
it's an interesting list.
Good.
When you get to the bottom, Bitcoin, Family Dollar, Dollar Tree, it seems like people are almost mad about the economy in some ways and the way that they're answering this with trust. Because then when you go all the way up, you're seeing like classic staple companies, right? Like a Costco or Trader Joe's where things are still kind of cheap.
Mm. That's true. I was going to say, it actually surprises me that you said Dollar Tree was at the bottom of that list.
Dollar Tree and Dollar General.
Huh, you would think that might be something that people have a stronger brand value, and especially at a downturn. But hey, who knows? All right, guys, let's move on to the next story here that we're tracking, and that's Peloton. They're trying to backpedal a little bit, prove that they are more than just selling bikes and treadmills. The retailer out with a new pricing system for their membership options. 3 new tiers for the app memberships. There's a free one, which doesn't cost you anything, App One, which is $12.99 a month, and then there's also App Plus, $24 a month. Peloton certainly has been struggling now for some time. Josh, there's been a big focus on services under Barry McCarthy. The process of turning around Peloton since it did peak, this could be a step in the right direction.
It could be a step in the right direction. Remember, when you think about Peloton specifically for this quarter, they were projecting the first quarterly membership drop ever. And so that's kind of like membership is what people on the street are focused on right now, as Peloton just hit an all-time low about a week ago now. So that's kind of a direct response, right, to maybe re-spark membership. I know we have a couple of Peloton users at the desk, so I'm just curious, what attracts you guys as far as that goes? Is paid product, free product?
Yeah,
okay.
I think the free product though is pretty smart because they're trying to attract more users, right? They're not going to make any money off it, obviously, from the free app, but they're looking to get people into their system, get people hooked, and then hopefully they're going to upgrade.
Yeah, the free stuff. I mean, look, Netflix has proven that people want free goods, right? And I don't know how they're going to monetize the free app. Maybe there's some sort of advertising, who knows? But why not, right? Why not try to skim those users that are at the bottom of like your profit triangle that don't want to actually pay for anything? I mean, look, I'm on my sister-in-law's account, so I'm not paying, but I use it a lot, right? So I would check it out, and I think that those mid-tier and upper-tier options are good for people that want a bit more. They have the bike, they want to be connected to it. So I think it's a good idea, and it's smart. I mean, look, Peloton a couple years ago, they wanted to get into the manufacturing business. They wanted to build their own bikes. That's a horrible idea. No one does that. Apple doesn't even do that. They have Foxconn do it. So this is a better way to focus company on what's what matters? High margin software stuff.
Yeah, and it's not lost to me that Barry McCarthy, he was the CFO at Netflix and Spotify, and in media right now, we're seeing all these various pricing tiers. So I think it's smart. My friends love the Peloton app. They use it frequently, and at $24 a month for that high-end tier, I'm going in a SoulCycle class in New York City and it's dropping $40 on a 45-minute class that starts late, ends early. I'm like a clown for doing this.
$40 per class, too, right?
$40 per class, never even goes the full 45 minutes.
$24 per month.
That's a huge
in the scheme of fitness actually isn't that expensive.
Yeah, but I also think a lot of people maybe that are subscribing to this app also belong to a gym, so it could be on top
Well, that's
of
a
their
personal
membership,
finance problem for them, right?
Exactly. All right, guys, let's move on here. There's a recent poll out really showing us what Americans care about when it comes to work. Is from the Washington Post and Ipsos. Now, workers care much more about pay than they do about remote work. 45% saying that pay is the most important aspect of a job versus the 7% who say the ability to work from home or remote is most important. And you can see more of the rankings here. 14% of workers say good boss or manager is extremely or the most important to them. 8% talking about the healthcare benefits. Guys, my big takeaway was on a positive note from this survey. The amount of people who are satisfied with their jobs. 80% say that they are very satisfied with their jobs. Nearly 2/3 say that they have a good work-life balance. That surprised me, given the fact that we talk so much about the high burnout rate given the pandemic.
And the thing that stuck out to me that I was looking at with that was kind of Gen Z and where they answered here, because I am a high-end part of Gen Z, but I'm always curious where that sort of falls. And I thought it was interesting to see that they said that 52% said they don't work enough and excel enough to advance their jobs. That was lower than what you saw from ages 35 to 49 and lower than what you saw from ages 50 to 64. So I thought it was interesting to see Gen Z basically admitting, and I hear this anecdotally all the time, they do strive for work-life balance. And that's kind of what you're seeing with the younger generation of work right now, that, you know what, maybe they don't want to work a 12-hour day. They'd rather work an 8 to 9 hour day. And then sort of admitting maybe that means they're not going to get a promotion. And maybe that's why they're happy, though. Maybe that's why 80% of people are satisfied with their jobs in some sort of balance.
Yeah, it is interesting to me. And like going back to your point, Shauna, with, you know, higher pay is good for workers, managers, having a great manager, that's important for workers. That's all very obvious to me. But one thing that stuck out was the workplace bestie. People that have friends at the office. 55% of workers say they have close friendships at work. 45% said they do not. And that was even evident with remote workers. Now, about half of remote workers said that they have close work friendships compared to 60% of hybrid and in-office workers. But I consider you guys all my friends. And I do think that helps with the satisfaction you have at the office. Showing up to work, liking the people that you work with, even if they're not your direct boss or manager.
Yeah, it plays a lot into the culture of the place.
You know, I think following on what you said about the 80% people were happy, it was very surprising.
You're stuck on that point.
I just can't believe 80% of people are happy in general.
In this group.
But I did see that only 22% of people are actually fully at work. Most people are hybrid, and that's down from 60% pre-pandemic, right? So I guess what's happening is that there's more choice, so maybe you're happier that way. Maybe you're still burnt out, but you're overall maybe happy about that. Another thing is that, of course, what's the most important thing? Cash, pay. Don't care about pizza parties. Don't care about free treats. People want to get paid, and that's what makes them happy. So maybe give them choice where they work. Give them some cash. You got to work for it.
People want to feel empowered, right? And I think people like being able to have that choice. Even if they come in 4 days a week and they're choosing what 4 days they come in, people just like having a little bit of choice. And yeah, money's always going to win.
People do like having a lot of choice, but pay, a mentor. I'm a big proponent of that. I almost think that's arguably the most important, especially early in your career. All right, United is going big in Denver, announcing more than 24 additional flights from the Mile High City. Earlier, Yahoo Finance's Brian Sozzi asked United Airlines CEO Scott Kirby why they selected to expand in Denver.
So Denver has been a phenomenal airport for us at United Airlines, and the city worked with us and built more gates. We're opening 12 more gates. We got a couple more clubs opening soon. We're the largest private employer here in Denver. We've added 35 new flights. It is basically tied with Chicago as our largest airport in the country now, but we have more gates here than anywhere, and so growth to come in the near term, but also in the years ahead. It's a great growing city, great geography for connecting customers across the country. We're really excited about everything that's going on for us here in Denver.
Scott, you made a very interesting point in the press release on this morning, that this might be a hybrid work play by United. Explain that to us.
Yeah. So, I've been saying hybrid work makes every weekend a holiday. And so when people are going to the office, 3-4 days a week, it used to be if they were, tethered to their desk from 9 to 5, Monday to Friday, they couldn't get away for the weekend because it just wasn't enough time. But now they can leave Wednesday night or Thursday morning and go somewhere, go to Florida or go to Cancun or go up to the Poconos or whatever it is. And they work remotely for 1 or 2 days. And so they're still online and they're still working, but they work remotely. And so it means there's just a structurally higher level of travel than there was before because people weren't constrained by money, they're constrained by time. And taking that time constraint off gives them more ability to travel. And when we see that happening, and have seen it happening for the past kind of year and a half.
Scott, for investors not too familiar where else you're putting capital to work, so $1 billion in Denver, that's a very large number. Where else are you investing in the United States at the same level or even more?
Well, by far our biggest investment is in aircraft. We've got the largest aircraft orders in history coming this year and in the years to come. So we're going to spend a little over $8 billion in CapEx this year, mostly on aircraft. We're making big investments at almost all of our airports, but the big CapEx number for us is aircraft.
And I see the 737 MAX by Boeing will be part of your planning in Denver. Mm-hmm. Is there still customer hesitancy on getting on that airplane?
No, I mean, it's a great airplane, very safe airplane, and there's no impact at all.
Talk to us about Memorial Day weekend demand. It's expected to be very strong. Compared to when we just heard from you a couple weeks on earnings, how is the demand environment looking?
Look, the demand environment remains very good. We've had 6 of our 10 highest in history revenue booking days here in the month of May. The other 4 were all in March before Silicon Valley banking scare. So the demand environment remains very good. We're expecting all-time records this weekend, but consistent all-time records as we go through the summer, and expect to continue to break the booked revenue records as we move forward.
What is growing faster, U.S. or international travel?
So international is growing faster. International is growing faster really across the board. And a lot of what happened last year is international borders were still tough, either completely closed or there were all kinds of requirements to get in around COVID. And so that caused a surge in demand for domestic travel. This year, borders are open. A lot of people are able to go for the first time. And so long haul international in particularly is the strongest part of the network.
We were looking at the latest CPI data, Scott, and we noticed that prices for airfares have started to come down a little bit. Is that because of more capacity in the airline industry or consumers balking at some of the higher prices?
No, I think this is really just a function of COVID. Airfares went up a lot last year, as there was coming out of Omicron and with the pent-up demand. And so they're now coming back to kind of the trend line of where they were before relative to GDP. So we all expected this. I don't think there's anything to read into it other than this time last year was this really surge, especially for domestic demand, and that CPI data is heavily weighted to domestic because people couldn't travel internationally. And so last year was the anomaly, and this year is back to normal trend line.
As an airline, Scott, that is investing billions of dollars each year, airplanes, infrastructure like in Denver, how concerned are you about what's going on in Washington right now with the debt ceiling debate, and how destabilizing could that be to your business and the overall airline industry if there is a default?
Well, first, I've already talked about demand is really good for us. And so it feels to me like the economy we're going to make it through this, fighting back against inflation with either, a soft landing or at worst a mild recession. But the economy is balanced on a knife's edge. When Silicon Valley banking scare started, we saw a 15% overnight drop in business bookings. And that tells you that the economy's very fragile. And that's what I'm worried about with the debt ceiling. And, we don't need an unforced error in the economy. And this would just be an unforced error. And I really hope that our politicians can find a way to compromise. And I'm bipartisan in that, both sides compromise and get a deal done because we're going to make it through a tough period, I think without a lot of damage unless we do harm to ourselves. So let's not do harm to ourselves, not have an unforced error around the debt ceiling.
A lot of leaders I talk to, Scott, share your sentiment, absolutely. But as a leader, as a CEO of a very large company, do you put plans in place if it doesn't go according to plan?
Well, there's not much for us that we're going to do different in the short term. If you're in banking or, part of the financial plumbing, the way I think of this is the debt ceiling would be the first domino, and there's a bunch of dominoes lined up in the financial system. And that's really where we have really bad outcomes if some of those dominoes start to fall. And so, I think they're really focused on what to do on day one. For us on day one, it doesn't change. Our domino is more at the end of that chain that, if the debt ceiling crisis turns into a bigger crisis is where we're really impacted. But we just shouldn't take the risk. I mean, it's a silly, silly, silly risk to even think about letting that first domino fall.
United Airlines CEO Scott Kirby there speaking to our very own Brian Sazi. Well, Qualcomm is building on its partnership with Microsoft today, unveiling new features to scale on-device AI. That announcement at Microsoft's Build Developers Conference means further integration of Qualcomm's Snapdragon in Windows devices. Qualcomm saying in a statement, quote, on-device generative AI solutions allow developers and cloud service providers to make generative AI more affordable, reliable, and private by moving queries and inferences to edge devices, including PCs and phones. Joining us to discuss is Ziad Asghar, Qualcomm's Senior Vice President of Product Management. We've also got our very own Ali Garfinkel joining in on the conversation. Ziad, good to talk to you. The announcement today really does build on an existing partnership you've already had with Microsoft. Talk to me about the scale of the opportunity you see in this partnership centered around AI with Microsoft.
I think this generative AI opportunity is just amazing for Qualcomm. You have to understand that this is how we're able to bring all of these experiences onto the devices that are in people's hands. Right now, many of these generative experiences are sitting in the cloud. So people at large are not able to access these experiences. But now, whether you think about productivity applications on PC-like devices or other entertainment-like applications on smartphones, with this change that's coming right now, with the technology that we have been building, we can actually bring all these experiences to the edge devices, to your PCs, to XR products, to smartphones, to IoT products. And that's really the amazing opportunity for Qualcomm. And we believe we have some unique, differentiated technology that sets us apart from everybody else in this space.
Ziad, Ali here. Investors aren't necessarily thinking of Qualcomm as an AI stock, but should they? How big of an opportunity is Qualcomm looking at in AI?
Oh, absolutely, right? So think about it. If you think from the perspective of privacy, if you think from the perspective of the contextual data that's available on a device, to be able to run these generative AI use cases, large language models on the device, it completely changes the story. It allows people to be able to run these devices while keeping those queries private, to be able to generate that experience even when you're not connected, to be able to use the contextual information in a way that basically you can give a far better experience to the user than is possible today. So let's take an example, right? So if you're talking about you're creating a virtual world around you, if you already know the kind of textures, the colors, the themes that you like, we can actually optimize that experience for you. So the experience is better. The privacy is basically preserved. You have the experience whether you're connected or not. And essentially, the experience is far better. So we really think this brings the generative AI opportunity to the edge and really moves the center of gravity towards edge devices. So it's a massive opportunity for us at Qualcomm.
Yeah, I've heard you say over and over about the experience here. It feels like we're just really at the tip of experiencing generative AI. What does that future look like? When you talk about user experience on your smartphone, what are we talking about?
You know, let's take an example, right? So on the smartphone right now, you take a picture. Already we are using AI to be able to enhance the quality of that image. But what we can do now is you can literally talk into your smartphone and you can say, well, put me in front of the Eiffel Tower at sunset with the beautiful clouds in the distance. And, you know, we can go and run a text-to-image model that actually generates that background and puts you right in front of it, right? That sort of an experience, that sort of an interactive experience on devices is really, truly only possible if you can do this on the device. And, you know, what makes this possible is our special hardware. Our pedigree is about doing more processing at the lowest power possible. And that's precisely what we're able to do with AI too. And we can essentially do that on a device that's not plugged. Whereas some of our other competitors run it on, you know, graphics engines that takes hundreds of watts of power, will literally do these experiences with milliwatts of power. And that's what takes it to the masses. That's what takes it to every user that uses a smartphone at this point in time.
Ziad, we've heard a lot about AI risks in the context, for instance, of ChatGPT, which kicked all this off. But I'd love to hear a little bit about how AI risks look from your vantage point.
Yeah, so I think one of the main concerns that people have with some of the generative AI examples is privacy. You have seen some of the news come out recently about certain information getting out and staying and residing on these cloud servers. Well, with AI, generative AI running on the device, that query, that question that you ask from a text-to-text-like example stays precisely on the device. It never leaves it. So actually, we are able to address some of the concerns that people have. Of course, additionally, the models are continuing to get better. That will actually help with doing a lot more in terms of improving the experience and taking away some of the concerns that people have with these generative AI use cases. And of course, what is also going to happen is that people will actually get to use these experiences. I think this is a seminal moment in our industry because it really changes the way we interact with our products, with our devices. And this is not one of those things that kind of follow the hype curve. This is actually an example where we have customers coming out to us today and saying, I want to run these use cases on the device. So this is very true. And this is where we believe that we'll be able to actually address a lot of the concerns that people have. Another big, very quick concern that people have is the cost. Right? If you can imagine that these models are getting larger, the applications are growing, at the same time, a lot more people are using them, you will get to a point where you will not have enough resources in the cloud. So you actually need the edge to be able to do generative AI. And that's the unique opportunity for us.
So I'd love to take this a step further then and say, is it possible that the technology you're talking about developing at Qualcomm will make ChatGPT and apps like it more accessible and less costly?
Absolutely, right? So what we can do today, what we showed at some of our recent conferences was a 1 billion parameter model, what we call stable diffusion, running entirely on the device. We showed it today at Build, where that same model is now running on a PC. Now, what we have a roadmap for is to be able to do up to 10 billion parameters models on the device. And you can envision some of the models that are out there today, text-to-text-like models, and we see on a daily basis new modalities coming into it. Text to music, text to audio, image to video. All of those, many of those actually fit very well in this range that I'm talking about, which we believe can run comfortably on the device in a sustained fashion. And that's why it comes to everybody. It comes to anybody and everybody that has a smartphone or a PC or an XR device, not just connected to the cloud at this point in time.
Qualcomm, Ziad Asghar, good to talk to you today. You know, fascinating to think about all the applications for AI. Our thanks to Ali Garfinkel as well for joining in on the conversation. Time now to take a look at some of the trending tickers moving after hours. Shana?
Akiko, a number of names for you here. We have Urban Outfitters, Toll Brothers, Palo Alto Networks, and VF Corp. Kicking off with Urban Outfitters, we're looking at a gain of nearly 8% here in extended trading. The company beating on both the top and bottom line. The strength really from Anthropologie and Free People. Getting into some of those comp sales numbers, Free People was up 17% from a year ago. Anthropologie up 13%. Also, Urban Outfitters making some progress when it comes to inventory. Their inventory levels were off just about 6% on a year-over-year basis. This retailer has been an outperformer since the start of the year, up nearly 12%. Over the last year, up about 36%. Flipping over to Toll Brothers, giving us another picture of the home builders. Now that's stock up just about 3% here. Pretty strong numbers from the company. They boosted their full year delivery guidance for the second quarter. They also beat expectations. Revenue was up 10% from a year ago. Their CEO, Doug Yearley, was saying in this release that it is a healthier demand environment, very similar to what we have been talking about when it comes to the home builders. And they're seeing that demand from the second quarter, from their fiscal second quarter, continuing into their fiscal third quarter here. So certainly welcome news here for shareholders. Year to date, the stock is up nearly 28%. Cybersecurity play Palo Alto Networks, that stock up about 4% in extended trading. The company beating the street's expectations, billing growth of 26%. They also reiterated their full year guidance, adding to those gains that we've seen of just about 36% since January 1st. And VF Corp, the retailer, now this is a name that has North Faces in some of their brands, Vans as well. That's up about 4% here. One of the standouts in this report was Vans. The company is starting to see some progress in their turnaround efforts with that brand. They do expect Vans to return to growth in the second half of the year. When it comes to their most recent quarter results, they adjusted earnings did beat revenue, coming in line with expectations. Again, you're looking at a pop of about 4%, which is very welcome because that's stock off over 30% so far this year.
Well, it is closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. Netflix announcing its long-awaited crackdown on password sharing. In a blog post, the company says a Netflix account is for use by one household. It is offering those who have standard and premium plans the option of adding an additional member for $7.99 each month.
Looking ahead to tomorrow, Florida Governor Ron DeSantis is expected to announce his bid for the 2024 Republican presidential nomination. The governor will reportedly make the announcement in a Twitter Spaces with Twitter owner Elon Musk.
And NVIDIA releases its first quarter earnings after the bell. Analysts are expecting NVIDIA to report adjusted earnings of 92 cents a share on $6.5 billion in revenue. We'll be listening to see what they say about AI, which has been a boon to the company's stock. It's up 110% this year.
That'll do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here tomorrow.